The Federal Reserve Bank just flipped their stance on the economy again because they said, number one, they're going to cut interest rates by another 0.25%. And then number two, they said they're going to turn on the money printer again. On October 29th, 2025, the Federal Reserve Bank just finished up their most recent meeting where Jerome Powell, who is the chairman at the Federal Reserve Bank, made an announcement. The first announcement is that they're going to cut interest rates by another 0.25% because they're concerned about the job market. They're concerned about how the economy is slowing down, so they wanted to stimulate the economy, which really wasn't that big of news, but this is what the headlines were focused on, and I wasn't even going to make a video about it. But Jerome Powell took it one step further. He went on to say this: on December 1st, 2025, the Fed is going to end the reduction of asset purchases. What does that mean? In short, he said that the Federal Reserve Bank is going to start printing money again to prevent tightness in credit. In other words, to prevent a reducing of money supply. That way he can stimulate the economy, stimulate borrowing, and stimulate markets. So let's break this down. I want to talk about interest rates. I want to talk about quantitative tightening. I want to talk about inflation. And then I want to wrap this video up by talking about mortgage rates. So let's go through this one by one. The Federal Reserve Bank has what's called a dual mandate. That means they're supposed to make their decisions about the money based off of two things. Number one, inflation, and number two is the job market. And the most recent inflation numbers said that inflation is around 3% in the United States, which historically is close to the average, but is still higher than what the Federal Reserve Bank wants. Remember, the Federal Reserve Bank has said that they want 2% inflation, but we're still above that. Lowering interest rates generally increases inflation. Raising interest rates generally lowers inflation. So we have a time where inflation is higher than what the Federal Reserve Bank wants, but the Fed wants to cut interest rates, which would normally make inflation worse. Why? Because of the job market. Now, the data on the job market is a little bit interesting because we did not get the most recent jobs numbers. Why? Because the government is shut down. So the Federal Reserve Bank is making their interest rate decisions based off of their feelings and based off of previous economic data. And this is what Jerome Powell, who is the chairman at the Fed, said when it came to the economy, the job market, and cutting interest rates. Quote, available indicators suggest that economic activity has been expanding at a moderate pace, job gains have slowed this year, and the unemployment rate has edged up but remains low through August. More recent indicators are consistent with those developments. Inflation has moved up since earlier in the year and remains somewhat elevated. So if the economy is growing, if inflation is high, why do we want to cut interest rates to potentially cause inflation to be worse? And the big focus of the discussion was none other than artificial intelligence, AI. You might have known that recently Amazon cut 14,000 workers. Why? Because they made a big investment into AI and they don't feel that they're going to need as many human workers. Likewise, Elon Musk recently said on X, and take this with a grain of salt, he said this, quote, AI and robots will replace all jobs. Working will be optional, like growing your own vegetables instead of buying them from the store. So there's a lot of concerns about AI now taking jobs, even though the economy is growing. Companies are seeing big profits, but people are losing their jobs. Companies aren't hiring people because they'd rather employ an AI agent. That's creating a very weird dynamic in the economy. And this is where the Federal Reserve Bank is saying we need to start stimulating the job market to encourage more business investment to hopefully fix the job market before the job market gets even worse. But I want to talk about what Jerome Powell said about the AI bubble specifically, but this is where I do want to remind you that for those of you that are investors or want to become investors, I put together a free investing masterclass where I walk you through how you get started as an investor and find hidden investment opportunities before everybody else. I will lay out the exact framework that my firm and I use when we research investment opportunities to find them before they hit the headlines. And as a free bonus for registering for this investing masterclass, you're also going to get access to market briefs, which is my newsletter for investors, for free, complimentary. So if you want to get the investing masterclass and market briefs all for free, all you have to do is register, and I have the link for you down in the description below. So in this discussion where Jerome Powell was being asked questions about AI taking jobs and an AI bubble, One of the things that Jerome Powell talked about was the dot-com bubble, because in the late 1990s up until 2000, 2001, there were very high valuations of internet companies because everybody was so gung-ho on the internet and how the internet was going to change the economy and change the entire job market, kind of like what we're seeing today with AI. And what Jerome Powell said is that yes, there are similarities, but the difference is that the companies today that have these extremely high valuations, he didn't name a company, but you can kind of infer he's talking about companies like Nvidia. These companies with extremely high valuations actually have profits. They actually have business plans with real earnings. We didn't see that during the 2000 dot-com bubble bursting, and that's why Jerome Powell says he's not too concerned about this AI bubble that people are talking about. Now, I still have concerns about an AI bubble, personally, and I don't want to get too much into my personal beliefs, but I am 100% bullish on AI. I think AI is the future. I think either you're going to get ahead of it or you're going to be upset that you didn't. But I also believe that there's a lot of crap in the AI space. There's so much money going into AI. There's a lot of businesses that are building AI products that probably will not get used. That doesn't mean that AI is not going to be the future. That doesn't mean that AI is not going to be a big transformative part of our economy. But that doesn't mean that every single company is going to keep the same valuation, and that does not mean that every single company is going to continue to be around 10 years from now. So just my 2 cents on that. So when it comes to interest rates, the Federal Reserve Bank says that they're cutting interest rates slightly, and they also said you can probably see another interest rate cut in December before the year ends, but we don't know for sure. So he kind of kept you at the edge of your seat there. Then Jerome Powell talked about the real important part, which is quantitative tightening. And this is the part that I think a lot of people are glancing over, but this is the part I would rather you pay more attention to. Because in 2022, the Federal Reserve Bank started what was called quantitative tightening, essentially trying to pull money out of the economic system. This is the opposite of what we saw in 2020, 2021, and the first half of 2022, which was quantitative easing, the printing of money. So quantitative easing was creating more money and injecting this money into the economy. This way, banks had more money to lend, businesses had more money, consumers had more money. There was just a huge influx of dollars into our economic system between 2020 and 2022. Well, after that huge influx of money, we saw a lot of inflation. We saw this widening wealth gap. We saw a lot of changes happen in our economy. That was when, in 2022, the Fed did 2 things. Number 1, they started raising interest rates. And number 2, they started quantitative tightening. Now, I'm not going to go too deep into raising interest rates because I've already kind of talked about interest rates in this video. But quantitative tightening is where the Federal Reserve Bank tried to take money out of the economic system by selling off certain assets on its balance sheet. Because remember, the Federal Reserve Bank, although they're called the Federal Reserve Bank, it's actually not a bank. You and I can't go there to deposit money. It's not a reserve. They're not sitting on any cash reserves. And they're not federal. It says so on their website. But they have the ability to print money. And when they print money and lend it to the United States government, that loan sits on the Federal Reserve Bank's balance sheet. And so over the last 2.5 years or so, the Federal Reserve Bank has been trying to reduce the size of its balance sheet, meaning stop printing so much money. And now Jerome Powell has said that come December 1, 2025, they plan on stopping this program. They want to start quantitative easing again. He didn't exactly say that, but when you stop quantitative tightening, what is the alternative? Quantitative easing. He's concerned that there is too much of a tightening of credit in our economic system, which is making it more difficult for businesses to qualify for loans, which is making it more difficult for people to qualify for loans, which is making it more difficult for the government to spend money they don't have. And so if the Federal Reserve Bank is to stop this quantitative tightening, we could see an increase of money printing, which could create an increase in inflation, which could create a boost in markets. And this is where we're starting to see a lot of very interesting things happen, because we have record high asset prices, record high stock prices, record high real estate prices, close to record high gold prices, close to record high crypto prices. And at the same time, interest rates are going down. At the same time, the Federal Reserve Bank wants to print more money. Now, this is why it's so weird. Normally, when you have inflation, you have these record high asset prices, you have this growing economy, the Fed wants to cool the economy down. But that's not what we're seeing. They're saying we want to stimulate the economy even more. We want to build up these bubbles even more. So normally, lowering interest rates don't pop bubbles, they inflate bubbles. But at the same time, we have this very interesting thing happening with artificial intelligence, which is people are losing jobs because of AI. It's becoming harder to get a job because of AI, especially if you are an entry-level person and you're getting out of college, trying to get a job. Well, it's extremely difficult now because AI has automated a lot of entry-level jobs. So those are a couple pieces of the dynamic in this economic system that I want you to pay attention to, that obviously we're trying to keep you posted here. And this is where I want to talk about inflation, because the Federal Reserve Bank was very hesitant to cut interest rates for most of 2025 because number one, they were concerned about the economy. Number two, they were concerned about tariffs. And so they were concerned that these things would overpower the inflation problem that we have, and they wanted to see inflation come down to 2%. Well, inflation has not come to 2%, and inflation of 3% does not mean that the prices of things are falling. It means that the prices of things are rising less fast than they were when inflation was 8%, but the prices of things are still rising every single year. And so if the Federal Reserve Bank continues to cut interest rates, if the Federal Reserve Bank starts to increase how much money is in the system, our economic system, come December, that could create more inflationary concerns. Not to mention the fact that tariffs are not gone away. There's a lot of banks out there that are saying the last part of 2025 or the early part of 2026 is when we're going to start to see more price hikes because of tariffs. So when it comes to inflation, it's something you're going to want to keep a close eye on. And it will be very interesting to see if the Federal Reserve Bank even pays attention to inflation, because even if inflation goes up, it sounds like they're more concerned about the economy and job market than they are about actually trying to contain inflation. And that's a concern, because if inflation gets too hot, that can hurt the value of the dollar even more. And well, there's been a lot of concerns about the dollar already. This brings me to the topic of the housing market. And you might be saying, well, Jaspreet, what the heck does the housing market have to do with all of this? Well, a lot of people, when they hear interest rates are being cut, they think mortgage rates. Are mortgage rates going to go down? And this is where I want to explain that mortgage rates and interest rates don't directly move hand in hand. When the Federal Reserve Bank cuts interest rates, they cut what's called the federal funds rate. That's not your mortgage rate, it's not your car loan rate, it's not your credit card interest rate. That's the interest rate that banks pay one another when they lend money to one another. So when the Federal Reserve Bank cuts this federal funds rate, banks get to borrow money for cheaper, which means when you put your money into a high-yield savings account or into a savings account or into a CD, a certificate of deposit, your bank is going to pay you less interest. But the other side to that is when banks charge you interest for a mortgage or a car loan, they look beyond just the federal funds rate. They look at what their investment options are. Because remember, when the bank lends you money, it's an investment for the bank. And so the bank is going to factor two things. They're going to look at risk and reward. So when the bank thinks about this pile of cash that they have that they can lend out to you, they have to compare what their options are. They can lend money to you, they can lend money to the United States government, or they can lend money to your broke cousin Bunty. Your broke cousin Bunty is probably not going to pay the bank back. So the bank has to charge him a very high interest rate because he's not creditworthy. He doesn't have a good ability to pay back his bills, and they understand it's a higher risk, so they want more return for that. When it comes to the United States government, that's considered a risk-free investment because the United States government can always pay back their bills. Now, there's been a lot of talk recently about is the United States government really a safe investment? And the thing is, the United States government will always be able to pay back their bills because they can just work with the Fed to print money to pay it back. It doesn't mean that the payment that they give you is going to have the same value as before. They might just inflate the value of your payments, but they can pay back their bills. So the United States government is less risk, less reward. And then they have to figure out what they're going to charge you. So the interest rate you're going to pay is going to be higher than what the United States government would pay. And so this is where the Federal Reserve Bank and your bank will look at what's called treasury rates. More specifically, your bank is going to look at what's called the 10-year treasury. The 10-year treasury is the interest rate that the United States government is going to pay out when you lend your money to the government for 10 years. And so when you want to understand where mortgage rates are going, you have to understand what the 10-year treasury is at. If the 10-year treasury is not falling, your mortgage rate is not going to fall. If the 10-year treasury is falling, your mortgage rate is going to fall. If the 10-year treasury is rising, you're going to have a more expensive mortgage rate. You get the idea. Now, the factors that influence the 10-year treasury include the federal funds rate. It includes people's concern about inflation. It includes people's concern about interest rates. It includes people's concern about the economy. And a lot of people have been talking about interest rates being cut right now. And because this interest rate cut that the Federal Reserve Bank just did was already so anticipated, it doesn't really move the 10-year treasury because investors had already factored in this interest rate cut before it even happened. So that's why you're probably not going to see a big drastic change in mortgage rates because it was already anticipated. But you want to pay attention to the 10-year treasury if you want to understand where mortgage rates are going to go. When the 10-year treasury falls, you will see mortgage rates fall. And that will happen when people are less concerned about the dollar. It will happen when people are less concerned about the economy. And it will happen as the Fed cuts interest rates even more. And this also has a double-edged sword factor as well, because if mortgage rates were to fall drastically, that could also make the inflation problem worse. Because if it was much cheaper to get a mortgage, to get a car loan, to get credit card debt, people are going to spend more money. And if people start buying more houses and buying more cars, house prices, car prices could go back up, which then could make the inflation problem worse again. So you can start to see the difficult dilemma that the Federal Reserve Bank is in. And we also know, the last thing, is that in 2026, Jerome Powell, who is currently the chairman at the Federal Reserve Bank, his term is going to expire. And President Trump has been very vocal about wanting to replace Jerome Powell with somebody who's going to be much more aggressive in cutting interest rates. So we could see more aggressive interest rate cuts in 2026. If that happens, we could see lower mortgage rates come the second half of 2026, but a lot of question marks before we get there. So the Federal Reserve Bank cut interest rates by 0.25%. Not major news, but the big news is that the Federal Reserve Bank says that they're going to stop their quantitative tightening on December 1st, 2025. That's something you really want to pay attention to because that can re-trigger inflation, that can re-trigger markets, and you want to see how aggressive they are now with money printing again. The Federal Reserve Bank said that they are considering cutting interest rates again in December 2025, and there's a lot of talks about Jerome Powell being replaced in 2026 with somebody who will be more aggressive in wanting to cut interest rates. All of these things impact the economy, they impact markets, and they create opportunity for the financially savvy if you can understand what's happening, understand how it creates investment opportunities. Again, that's why I created my investing masterclass. If you want to watch that, I have the free link for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. And I apologize for the echo in this video. I was not in the office. I wasn't planning on making this video. But then when the announcement came out that on December 1st, we're going to stop quantitative tightening, I felt like I needed to make this video. That way I could at least get this information out there. Thank you again. I'll see you on YouTube tomorrow.